some European stock exchanges are much smaller than the US, but what we have built over the past 25 years, in particular over the past 10 years, is something where the numbers are compelling in terms of liquidity. We have a single technology platform, a single order book, a single liquidity pool. This liquidity pool trades every day something between 11 and 12 billion euros. The aggregate market capitalizations of the companies listed in this single integrated European pool of liquidity is above 6.5 trillion euro. This is more than twice the size of the London equity market. It is more than 3 times the Frankfurt equity market. We have built the largest liquidity pool for equity in Europe. Yes, it is still smaller than the US, but yes, it is already the largest liquidity pool in Europe. That's why we attract more international IPOs than others, because we have decided that equity does matter. Other exchanges have decided that equity doesn't matter as it used to do, and have decided to diversify away. We are diversifying, but we do consider that the purpose of a market infrastructure is to connect local economies with global markets and to power global markets to finance the real economy. Now, that's why we are being successful so far, and that's why the integration of Greek capital markets and Greek stock exchange and Greek market infrastructure within the Euronext family is so important, because it shows that we do capital market union for real.
Does it also suggest that there is a coming of age again for Greece itself? If we reflect back on several years ago, there would have been perhaps some pushback about further integration of Greek assets because of where Greece was. Some of the fragmentation was really triggered by the weakness we saw in these peripheral European countries.
Thank you for asking this question, because this city has invented back in the days, 15 years ago, the concept of pigs. You remember the famous concept of pigs: Portugal, Ireland, Greece, and Spain. Today, Greece buys or borrows for 10 years bonds at something like 3.3%. The UK borrows around 4 point something percent for 10 years. France at 3.4%. So all those pigs country borrows for 10 years at a cheaper price than France and the UK. So the Greece is going to celebrate this year either the second or the third year of budget surplus, which is a dream for both the French Minister of Finance and for the UK Chancellor. So I think the reality of Greece being back, because of all sorts of reforms implemented over the past few years, and in particular because of the huge efforts done by the Greek society over the past 10 years, is something amazing. That's why we believe that it is the right time to invest in Greece. This is an amazing economy, a society which is unbelievably open to globalization and to the rest of the world, with great talents, and we are very happy to start embarking into this journey with them.